Ever stare at a stock chart and think, what am I even looking at? Imagine cracking that code, knowing exactly when a stock is worth your money and when to walk away. Today, I'm breaking down how to analyze stocks like a pro, the dead simple strategy that even total beginners can use. No MBA, no complicated math, just crystal clear steps to help you invest smarter and grow your money with confidence. So if you're ready to leave guessing behind, smash that like button, hit subscribe, and tell me in the comments which stock you've always wanted to figure out. Let's turn confusion into clarity, right now. 5. Start with the story, because every great investment is rooted in human ambition. Imagine it's a rainy evening. You're at your kitchen table with a hot cup of tea, laptop glowing, digging into the origins of a company you're thinking about investing in. Before you even glance at balance sheets, you look for the story, because behind every stock ticker is a dream that someone decided to chase. Think of Jeff Bezos sitting in a small office, boxes stacked to the ceiling, telling early Amazon employees that one day they'd sell everything to everyone. Or Howard Schultz walking the streets of Milan, enchanted by Italian espresso bars, determined to bring that communal cafe culture to America with Starbucks. Or even the founders of Zoom, convinced people wanted simpler, more reliable video calls long before the pandemic forced the world online. When you start by understanding why a company exists, what burning problem it's trying to solve, and how deeply that mission resonates with customers, you lay the emotional groundwork. You're not just buying numbers on a screen. You're buying into a human story. Ask yourself, does this story have real gravity? Is the company building something that fits not just today's needs, but tomorrow's? Could you see their products or services being even more essential in 5, 10, 20 years? Or does it feel flimsy, like it's only surviving on hype? The story gives you a powerful filter. It focuses your curiosity, helps you see beyond quarterly blips, and keeps you anchored when everyone else is distracted by market noise. Because the best investments are those you can hold through storms. And that's easiest when you believe in the narrative driving them forward. 4. Dive into the financials. Let the numbers prove the story's real. Now that you've found a story that excites you, it's time to step into the colder world of numbers. Because a dream is only worth investing in if the business model turns that dream into dollars. Picture opening up the company's income statement. Your eyes run down lines of revenue and expenses. Is this company steadily growing its sales year after year? If revenues jumped from $200 million to $400 million over 5 years, that's a sign the story is translating into real customer demand. Then look at profit margins. Is the company keeping more of each dollar it earns, or are costs ballooning? A business with gross margins climbing from 30% to 40% shows it's finding efficiency or pricing power, both signs of strength. Now flip to the balance sheet. Is the company sitting on a pile of debt? If it's leveraged heavily, a recession or rising interest rates could trigger a financial heart attack. But if it has ample cash reserves, it's better equipped to ride out tough times. Finally, the cash flow statement. This is where you see if they're actually generating real cash from operations, or if they're constantly raising money through new debt or issuing shares. Strong free cash flow means they can invest in growth, buy back stock, or pay dividends. All good for your $100 investment. Run your mental test. Is this business growing, becoming more efficient, and staying financially healthy? If the numbers back up the narrative, you've got something powerful. If not, it might be just a pretty story with hollow bones. 3. Study the competition. Find the moat that makes your investment safe. Now zoom out from the company itself and look at the wider battlefield. Even a brilliant business can get eaten alive if competitors swarm in and start undercutting prices or offering better tech. Think of how Nokia and BlackBerry once ruled the phone world. Then along came Apple's iPhone with its sleek touchscreen app ecosystem, and the old giants were left in the dust. Or how Blockbuster laughed off Netflix's tiny DVD mail service, only to watch it morph into a streaming juggernaut that erased their entire business. This is why professional investors obsess over moats, those unique advantages that keep competitors at bay. A moat might be brand loyalty, like people who refuse to buy anything but Nike shoes. It might be scale, like Amazon's warehouses that let them ship faster and cheaper than almost anyone, or regulatory barriers like a biotech firm holding patents on a groundbreaking drug. Read industry reports, listen to competitor earnings calls. Ask how easy would it be for someone else to steal their customers. What are the switching costs for a client to move to a rival? The deeper and wider the moat, the more secure your $100 investment becomes. A strong moat means that even when tough times hit, this company can hold on to customers, protect profits, and keep growing while weaker rivals fall away. That's how long-term wealth gets built, not just from finding a good business, but one shielded from endless hungry challengers. 2. Check the valuation, because even the best business is a bad buy at the wrong price. Now comes the moment where discipline matters most. You found a company with a compelling story, bulletproof financials, and a sturdy moat. It's easy to get swept up and buy at any cost. But that's how you end up holding a wonderful business that delivers lackluster returns because you paid too steep a price. Imagine walking onto a car lot and seeing your dream car. Perfect model, low miles, gorgeous color. But the dealer wants $100,000 when similar cars go for $40,000. No matter how much you love it, you'd walk away, right? Stocks work the same way. Even the strongest company becomes risky if it's priced for perfection. Look at the price-to-earnings ratio. How many dollars are investors paying for each dollar of current earnings? Check the P/E ratio, which factors in expected growth. A company might look expensive today, but if it's expected to double earnings over the next 3 years, the high sticker price could still make sense. Also compare price to free cash flow. A business gushing free cash but trading at a modest multiple might be a gem. Meanwhile, a hot company with a nosebleed valuation means your $100 is more fragile. It could get sliced in half on a single disappointing earnings report. Pause for moments when the market overreacts to short-term fears, dragging down the price of a fundamentally strong business. That's when your $100 buys more intrinsic value than it should, setting you up for big gains as reality catches up. 1. Automate your emotions, because that's what separates investors from speculators. Now here's the hard truth, and it's the reason most people never build serious wealth in stocks, no matter how many books they read or ratios they memorize. Even the best analysis can be torpedoed by raw human emotion. Picture this. You've done everything right. You found a brilliant company with a rock-solid story, rising financials, and ironclad moat, bought in at a fair price. Your $100 investment grows to $150, then $200. You're thrilled. Then out of nowhere, bad headlines hit. Maybe a lawsuit. Maybe a global shock that tanks all stocks. Suddenly your investment slides to $140, then $120. Panic creeps in. You think, maybe I should just cut my losses before it drops more. Or flip it. Your stock rockets. Your $100 becomes $300 in a flash. Greed whispers, why not sell now, lock in gains, and jump into the next hot thing? That's how most people sabotage themselves. They let short-term fear and greed override their long-term logic. Professionals automate discipline. They use portfolio rules, like never putting more than 5% of their total wealth into a single stock. They automate regular investments, buying more on dips without even trying to time them. Some set alerts or even automated sell triggers to keep emotion out. They focus relentlessly on the business itself. Has the story changed? Have the financials broken down? Has the moat been breached? If not, they stay put, adding more when the market panics, calmly holding through storms that shake out the weak hands. Because over decades, it's the calm, steady investors who build the fortunes, the ones who automate not just their buying, but their entire emotional response. Their system means that whether the market is on fire or in free fall, their strategy doesn't change. That's the ultimate edge, more powerful than any spreadsheet trick or secret ratio. This is how you analyze stocks like a pro with a deceptively simple, timeless approach. You start by uncovering the story, because businesses live or die on human ambition and customer love. You dig into the financials to see if that story is backed by real dollars. You study the competition to make sure there's a protective mode. You check the valuation so you don't pay so much that your upside vanishes. And then you automate your discipline so your instincts can't betray your carefully crafted plan. And that's it. You're fast-tracked to reading stocks like a seasoned investor and spotting real opportunities instead of falling for hype. If this gave you that aha moment, go ahead and light up that like button. Subscribe so you never miss more simple wealth-building strategies, and drop a comment telling me what company's stock you're itching to analyze next. Thanks for watching, and get ready, because in the next video, we're going even deeper into unlocking your financial future. See you there.